The India-UK Comprehensive Economic and Trade Agreement, which comes into force today, marks a new chapter in bilateral economic ties. It boasts of a potential to boost trade, investment and technology collaboration. But how transformative will it be for India's economy, businesses and global trade ambitions? Alongside it, a second agreement also kicked in, the Double Contribution Convention, a social security pact. Together, they're being called a gold standard deal by India's Commerce Secretary Rajesh Agarwal. Hello and welcome. You're watching NewsX Deepdive. I'm Savri Jindal. Two questions matter the most here. What actually gets cheaper and who really benefits from that social security pact? Let's go through both. The deal opens up one of the world's largest consumer markets to Indian exports while making several premium British products cheaper for Indian buyers. The agreement is also expected to deepen investment ties, create jobs and give a fresh push to India's manufacturing and services sectors, according to trade experts. For Indian consumers, the first visible impact could eventually be lower prices of imported Scotch whisky, premium British cars, cosmetics, chocolates and select food products. For Indian businesses, however, the bigger story lies elsewhere. Unpredicted access to the UK market. Notably, the agreement marks one of India's first major agreements with a developed economy to enter into force in recent years, helping Indian businesses become more familiar with advanced regulatory standards, compliance requirements and trade facilitation process that characterizes developed markets. Let's start with the basics. The UK has removed or cut tariffs on nearly 99% of the value of Indian exports. That's the headline number. But the real story is in the specifics because some sectors are getting dramatic cuts and some are barely moving. Processed foods have had tariffs high as 70%. Those are going to zero. That's the single biggest jump in this whole deal. Marine products, shrimp, fish, seafood had duties over 21%, that's also gone. Indian fishermen and marine export sectors get full duty-free access. Engineering goods and auto component carried tariffs around 18%. That's also zero from today. Leather and footwear, 16% tariffs has now been eliminated. Textiles and garments had 12% tariffs, which is now eliminated. This one matters a lot because UK already buys about 8% of India's total garment exports. So this strengthens an existing relationship rather than starting from scratch. Now here's the context that gets lost in the headlines. Over half of India's exports to the UK were already entering duty-free before this deal existed. So the actual gain over here is the new money on the table, which varies a lot from sector to sector. Processed food and auto components had almost no Indian presence in the UK market before. Less than 0.5% market share in some cases. So the upside there is real, but it will take years to build. Textiles, where India already had a foothold, may see faster gains simply because the infrastructure and buyer relationship already exists. On the other side, India also gave, in fact, Scotch whisky is the standout example. India's 150% tariff drops to 75% immediately and eventually to 40% over 10 years, though only above a minimum import price. So it's really the premium end of the market that benefits. Other spirits get similar phased cuts. As the UK secured limited duty-free access for electric, hybrid and hydrogen cars within an annual quota, even though India's standard auto tariff stays high outside that quota. India also protected a clear set of sensitive goods from any concessions at all. Dairy, cereals, edible oils, fresh apples, walnuts, certain cheeses, gold bars and smartphones. Those stay exactly where they were. One more wrinkle worth knowing. The UK tightened its own steel import rules just 2 weeks before this came into effect. Steel is about 7% of India's total goods export to the UK. So this could have been a real problem. Instead, the two government negotiated protections, quotas, and something called an authorized use scheme that officials say shield roughly 85% of India's steel exports from the new restrictions. Now to the second point, the Double Contribution Convention, or DCC. This doesn't get as much attention as the tariffs, but it directly affects real people's paychecks. Here's the problem it solves. If an Indian company sends an employee to work temporarily in the UK, that employee and their employer historically had to pay social security contributions in both the countries at once. In India, that's contributions to schemes like the Employees Provident Fund. In the UK, it's national insurance. Paying both on the same income for the same period is a real financial hit. And it made deploying Indian talent to the UK more expensive than it needed to be. The DCC removes that double payment. Under the agreement, Indian professionals on qualifying temporary assignments in the UK will be exempt from UK social security contributions for a defined period while continuing to pay into their home system in India. That period was actually extended during negotiations from 3 years up to 5 years, which was described as a meaningful late stage win for India. The Commerce Ministry estimates that benefits more than 75,000 Indian workers and over 900 companies. Who exactly does this reach? Mostly professionals on secondment or intra-company transfers, IT consultants, engineers, financial service staff, and other skilled workers sent by Indian firms to UK offices or client sites for a defined project period. But rather than permanent immigrants settling in the UK, the financial benefit is straightforward. Without the DCC, a portion of an employee's salary and a matching employer contribution would essentially be lost to a foreign social security system the employee will likely never draw a pension from since they're not planning to retire in the UK. With the exemption, that money either stays as take-home pay, gets redirected into the employee's Indian retirement savings, or reduces the overall cost for the employer of sending them abroad. For Indian IT and consulting firms in particular, which send larger number of employees to UK client sites, this lowers the cost of doing that business meaningfully. It's worth stepping back and seeing why these two agreements were bundled together and on the same day. The tariff cuts open the door for Indian goods. The Social Security Pact makes it cheaper to move Indian people and expertise into the UK to service that growing trade relationship, consultants who help exporters navigate compliance, engineers who support new manufacturing partnership, and financial professionals who structure the investment flows. So in plain terms, if you're an Indian exporter in food processing, seafood, textile, leather, or auto components, your cost of entering the UK market just dropped, in some cases to zero. If you're an Indian professional sent to work in the UK on a temporary assignment, you'll keep more of your income for up to 5 years. If you're a UK consumer of Scotch whisky or an importer of Indian steel, there are new rules, some more favorable, some more cautious, shaping how the trade flows from here. The tariffs took effect today. Whether the trade numbers actually double by 2030, as officials are projecting, depends on how quickly businesses on both sides act on the axis they've just been given. Joining us to take this conversation forward is Ms. Mitali Nikore, economist, who joins us on the broadcast. Ma'am, in your assessment, how exactly do you view the developments that have taken place, and what essentially are the big takeaways and the big benefits over here?
So, thanks a lot for having me on this conversation. I think, the first point to note is that in the last 10 years, from 2015 to 2025, we've already seen a massive increase in India UK trade, and which, now it's standing at about $50 billion from, just about $25 billion 10 years ago. So, in the last 10 years, we've doubled our trade with the UK. Now, it is projected that with this CETA, with the Comprehensive Economic Trade Agreement, we'll actually be able to double our trade once more, but this time in just 3 to 4 years. And that's going to come from a few sectors where there's a lot of unrealized export potential. That could be electronics, that could be pharmaceuticals, that could be machinery and equipment, that could be looking at sectors like professional services, even sectors like IT services, which have a huge market in the US, have actually huge unrealized export potential for the UK. So we really expect that IT and financial export of services can also emerge as a very important growth generator in the next 5 years. So it's a huge integration of these two markets. And I also think that it's a massive benefit for the UK economy, because the UK economy today has some innovations, but they are looking for scale. They are looking for large markets. They're looking for a place where they can, have a true partnership, an investment based partnership, and say, here is our technology, here is our know-how, but how do we scale this up? And India gives them that. So very honestly, for us, of course, a standard export argument, but for them, I would say a survival argument, to say that this is how the UK can continue to survive in a global environment.
All right, absolutely. With that, I'd like to thank you for joining us on the broadcast, sharing your perspectives with us. On that note, we submit to a very short break. Thanks for watching.